Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Spotify became the latest technology company to announce layoffs, saying they would lay off about 6% of the workforce. This came as a bit of a surprise for the company that is actually free cash flow positive, still growing. But I do think this might mark a strategic change for Spotify. I'm Travis Hoium. Thank you for watching Riiv Investing. Subscribe here on YouTube. I will have almost daily content coming out here. Spotify is one of those companies I'm really interested in looking at from a strategic perspective because I think this could be a booming market in both streaming music as well as podcasts. And that's the lens with which I want to read parts of Daniel Ek, the CEO's note to employees, and look back at third quarter results and have a little bit of a preview of what the fourth quarter could look like. I will link to Daniel Ek's blog post that he posted on January 23rd, but there are a few takeaways that I took from this. Here are the big ones, and I'm quoting directly here. While we've made some great progress in improving speed in the last few years, we haven't focused much on improving efficiency. We still spend far too much time syncing on slightly different strategies, which slows us down. And in a challenging economic environment, efficiency takes on greater importance. So in an effort to drive more efficiency, cost controls, and speed up decision-making, I have decided to restructure our organization. Like most companies, restructuring is really code for layoffs. But what I think we're seeing here from Ek is he's trying to reorient the company from focusing on growth at all costs to focusing on being more efficient and more profitable. He goes on to this, I think, really important paragraph. To offer some perspective on why we're making this decision, in 2022, the growth of Spotify's operating expenses outpaced our revenue growth by 2 times. That would have been unsustainable long-term in any climate, but with the challenging macro environment, it would be even more difficult to close the gap. As you are well aware, over the last few months, we've made a considerable effort to rein in costs, but it simply hasn't been enough. Now, there are small improvements that Spotify can make, but I think the big one that we're going to see long-term is the company cut back on its massive spending to acquire talent in the podcast business. The company has written huge checks to podcasters like Joe Rogan, Dax Shepard, and even acquiring a studio like Bill Simmons' The Ringer. One of the reasons the company needed to do this is it needed to establish itself in the market for podcasts. Not only did it want to become a place for people to go listen to podcasts, it was trying to build an advertising business that could help monetize podcasts. To attract advertisers, Spotify needs to have people listening and it has to have creators on the platform. So that's why it's spending tons of money to sign these exclusive deals. I think we are at the point now where Spotify is an established place for podcasters to go to for a number of reasons. It has tools to help monetize, it has an audience, and I don't know that it's going to get any incrementally better by writing another $100 million or $200 million check. So we have both the changes that Spotify can make to its employee base and the direction that the company is going and the mindset of the company from a spending perspective, as well as changing some of the big line items as well. So let's get to what those numbers look like. This is a look at Spotify's gross margin picture. You can see that overall margins have been pretty flat over the last few years. This is a quarterly number going back all the way to 2018. What's really improved over time is premium gross margins. You can see here significantly higher in Q3 2022 from Q3 2018. One of the reasons for that is the way the company's monetizing the music business. They're basically charging artists and record labels to appear in some of their discovery tools. That gets them an audience, but at the end of the day, it's a revenue stream for Spotify. This is a big reason that margins have improved on the premium side of the business significantly over the last few years. But you'll see that ad-supported gross margins have actually declined pretty sharply, only 1.8% in Q3 2022. Now, the ad-supported business actually includes all content costs for the podcast side of the business. Those big checks that they're writing to creators that I mentioned earlier, that is entirely going into this ad-supported business. So margins are going down. That's the wrong direction, especially as Spotify tries to reach a level of scale with both advertisers and creators. I think this is the piece right here, this ad-supported gross margin number. This is what investors are going to want to see improve throughout 2023. If this margin goes up to in excess of 10%, maybe even in excess of 20%, that's going to be a really positive trend for the business. Let's also look down here at free cash flow. This is free cash flow on a trailing 12-month basis for Spotify. You can see that over the last 4 years, the company has been solidly free cash flow positive. Now, this is not a stock that is trading at some sort of discount. On a price to free cash flow basis, it's trading at about 90 times. So that's not a great thesis for the company to buy it on as a value stock. But I do think it's worth thinking about if they are able to increase those ad gross margins, those podcast gross margins, cut costs, both from an operating perspective and also from a content perspective, this could be a very profitable business fairly quickly. I do think it's an incremental positive to see Spotify start to focus on the bottom line a little bit more. If we do see revenue continue to tick higher, both on the premium side of the business and the ad-supported side of the business, and we see costs decline sharply on the content side, that would be a positive and potentially a boost for the stock. Remember, this is one of the few players in the media business in both music and podcasts to have any sort of market share. Their big competitor is Apple, but Apple is not focusing on the business in the same way that Spotify is, particularly on the advertising side. So I do like where they're sitting, but they need to prove that they can make this a profitable company long term. 2023 is really going to tell us if that's going to be the case or not, especially after these cost cuts. And I think what we're going to see as far as a strategic shift from acquiring big name talent in podcasts to starting to monetize this business and generate better and better margins. This is a company that I'm bullish on long term, but a lot of questions to answer over the next 12 months. What do you think about Spotify? Is this a stock that you own? I'd love to hear your comments in the comments section below. Give this video a like, and of course, follow Riiv Investing. I will be back here regularly to cover Spotify, including after earnings. Thanks for watching. We'll see you here next time.